Imagine a bank with, no physical vault.
Right. And no human tellers either,
Exactly. Absolutely zero legal liability for its own marketing department, too.
which is wild.
It really is. A bank that's run from a desk in Lithuania, registered on a tiny island near Madagascar, and actively trades your money thousands of times a minute while you sleep.
Yeah, you're definitely not getting a free toaster for opening an account there.
Definitely not. But it completely shatters our traditional idea of what a financial institution is, supposed to look like.
Welcome to the deep dive. Today we're exploring a really comprehensive briefing document for a platform called NeoBank.
And just for you listening, this is not the brick-and-mortar bank on your corner.
Not
At all. No. It's this massive collision of high-frequency cryptocurrency arbitrage, institutional portfolio management, and, surprisingly, multi-level marketing. Okay, let's unpack this.
It's just a wild intersection of industries. And to really understand what we're looking at in these sources, we first need to establish their baseline philosophy.
Right.
So NeoBank, which operates officially at neobash.ltd, is basically built on this concept of dividing and conquering.
Okay, what do you mean by that?
Well, traditional commercial banks are usually monolithic, right? They're just one giant corporate umbrella.
Everything under one roof.
Exactly. But NeoBank operates as a decentralized asset management ecosystem. It's this web of highly specialized, isolated entities.
Interesting.
And they do this to automatically diversify the deposits that users make, and honestly, more importantly, to isolate risk.
Yeah, I noticed that isolation immediately when reading through the geographic and legal setup of this platform.
Yeah.
Because before we can even talk about how they claim to generate yields or manage a portfolio, we have to look at how they actually built the foundation.
Structural playbook.
Exactly. I was reading the section on their corporate structure, and I literally had to stop and reread it. They operate entirely out of the Union of Comoros.
Specifically the island of Anjouan.
Right, Anjouan. But then the platform is led by a managing director named Alexander Asasyov. He's a Lithuanian citizen, and their corporate address is sitting right in the middle of Vilnius, Lithuania. I mean, I understand globalization, right?
Right.
But why split a single platform into 5 separate companies in the Comoros while managing it from a desk in Lithuania?
If we connect this to the bigger picture of modern digital finance, it's actually a masterful regulatory strategy.
Oh, really?
Yeah, because in the crypto era, liability is, well, it's the enemy of innovation.
Sure.
And Anjouan has become this fascinating, highly flexible, crypto-friendly jurisdiction. It allows digital platforms to set up specialized legal entities rapidly.
Without the red tape.
Exactly,
Yeah.
without the crushing bureaucratic red tape you'd find in, say, London or New York.
Makes sense.
Meanwhile, operating the day-to-day out of Lithuania gives them access to top-tier European tech talent and established financial infrastructure.
Right. But it isn't just one company registered in the Comoros, is it? The briefing document mentions 5 entirely separate legal entities making up NeoBank.
5 distinct licenses, yes.
Yeah, I'm looking at this list and I see they have different purposes. But why go to the extreme length of incorporating 5 different times for one single platform?
Because of that core philosophy we mentioned earlier, risk isolation.
Okay.
So the central hub is NeoBank Ltd. That holds their international banking license.
That's the main vault, basically.
Right, but then they branch out. They created ARB Insurance Fund Ltd. Specifically to handle capital protection.
Just insurance.
Yeah. Then they have MLM Matrix Ltd. Solely for running the partner program.
Or marketing arm.
Exactly. Then they built Arbitrage Core Ltd., which holds a brokerage license for their trading algorithms. And finally, Arb Exchange Ltd. To handle cross-market liquidity.
I look at that structure and my mind immediately goes to, like, a segmented submarine.
Oh, that's a great analogy.
Right. You build a submarine with all these different bulkheads and sealed doors so that if one compartment hits a rock and floods, the other compartments automatically seal off to keep the entire ship from sinking.
That is a perfect way to visualize it. If regulators suddenly decide to, crack down heavily on network marketing in the crypto space, they might target MLM Matrix Ltd.
But the bank survives.
Exactly. Because of this segmented structure, the central banking platform, NeoBank Ltd., is a completely separate corporate entity. It's legally walled off from that fallout.
Wow.
Or if the arbitrage trading bots take a massive algorithmic hit, the insurance fund isn't drained because it's managed by a totally distinct company.
So it's essentially decentralized governance applied directly to corporate law.
Precisely.
Like bureaucratic armor.
Okay, so now that we understand this intricate, segmented submarine they've built, let's talk about what actually happens when you, as a listener, decide to put your capital on board.
Let's look at the actual products.
Right. The sources note that the barrier to entry is surprisingly low. You can open a deposit invoice with a minimum of just 10 USDT.
Very low barrier. Yeah. They also accept USDC, Bitcoin, and Ethereum. But for those who might not, trade crypto every single day, can you give a quick primer on what USDT and USDC actually are? Like, why does a platform like this rely on them?
Absolutely. So USDT, which is Tether, and USDC are what we call stablecoins.
Right.
Unlike Bitcoin or Ethereum, which can swing wildly in price based on market sentiment, stablecoins are specifically designed to mirror the value of the US dollar.
So 1 USDT equals 1 US dollar.
Essentially, yes. And platforms like NeoBank rely on them because it allows users to deposit capital without worrying that the underlying value of their deposit is just going to drop 10% overnight.
Just because the broader crypto market had a bad day.
Exactly. It provides a highly stable baseline for their trading algorithms to work with.
That makes a lot of sense.
Yeah.
So you drop your 10 USDT into the platform. But it doesn't just sit in a digital vault collecting dust.
No, it goes right to work.
The briefing document emphasizes that the system immediately and automatically splits your deposit into 3 equal 33.33% shares.
And those 3 shares are routed into 3 distinctly different banking and trading strategies within that Comoros ecosystem.
Now, this is where I got a bit tangled in the financial jargon. The sources state that a third goes to Arb Exchange, a third goes to Arbitrage Core, and a third goes to their crypto fund.
Right.
The crypto fund is easy enough to grasp, I think. It acts like a traditional long-term holding vault for digital assets.
Just holding it.
Yeah.
Yeah.
What is the functional, real-world difference between the cross-market exchanges happening at Arb Exchange and the computational order book arbitrage happening at Arbitrage Core?
It all comes down to how they are interacting with the global market. Think of Arb Exchange as moving money around to ensure the pipes don't dry up.
The plumbing.
Yeah, exactly. They're actively shifting assets between different decentralized and centralized platforms to provide liquidity. Just making sure there's always enough cash on hand in different places to facilitate rapid trades, and they earn fees for providing that service.
So they're getting paid to just be the middleman keeping the cash flowing.
Exactly. Arbitrage Core, on the other hand, is purely about exploiting real-time price gaps. Let's use a real-world example.
Okay.
Imagine you can buy a rare comic book at a garage sale on one side of town for $10.
Okay.
And you know a collector on the other side of town who will instantly pay $10.10 for it.
Okay, I see where this is going.
Right. So if you drive fast enough, you make a 10-cent profit risk-free.
But doing that with Bitcoin.
Precisely. Their algorithms scan major Tier 1 exchanges like Binance and OKX. If Bitcoin is selling for $60,000 on Binance, but someone is buying it for $60,010 on OKX, the automated bots buy and sell it across both platforms in the exact same millisecond.
Capture that gap.
Yeah, they capture that $10 micro inefficiency.
Yeah.
When you do that thousands of times a minute, 24 hours a day, those tiny fractions of a cent compound massively.
Here's where it gets really interesting. The yields they claim to generate from all this. NeoBank doesn't offer fixed interest rates like a traditional bank. The returns are floating.
Highly variable. Yeah.
They're calculated every single hour and paid out daily based on how well those bots performed. The sources cite an average of about 0.42% daily for USDT and Ethereum, 0.25% for USDC, and a massive 0.59% daily average for Bitcoin.
It's a huge number.
My jaw kind of dropped reading that. I mean, a traditional savings account might give you 4 or 5% a year if you're incredibly lucky. This system is aiming for nearly 0.5% every single day. How does an ecosystem sustain numbers like that without completely breaking under its own weight?
What's fascinating here is how they solve the exact problem you just identified.
The compounding math.
Yeah. In the broader crypto space, platforms that promise infinite high-yield returns almost always face a liquidity crisis.
Like a Ponzi structure.
Often, yes. They rely on constantly paying old users with new users' money, and eventually the compounding math catches up. They owe more money than they can possibly generate, leading to catastrophic insolvency. NeoBank avoids this by establishing a definitive ceiling,
which they call the 300% target contract cap. Exactly.
I really wanted to ask about this. The documentation says that every deposit you make is legally treated as an individual contract.
Right.
The payouts drip into your available balance daily, which, by the way, you can withdraw at any time. But it doesn't go on forever.
No, it stops the exact moment your total payouts hit 300% of your initial base amount.
It is remarkably similar to a specialized vending machine.
Oh, vending machine?
Yeah, like you put your $10,000 in, you stand there, and it dispenses your daily returns. But the moment exactly $30,000 has come out of the slot, the machine just unplugs itself.
Brick shuts off.
The contract closes. If there are any residual assets left over from that initial 10K still bouncing around the ecosystem, they now belong to NeoBank.
And that cap is the absolute secret to their mathematical survival. They cap their own liability.
Right.
By knowing exactly what their maximum payout is for every single dollar that enters the system, the algorithms can trade without the pressure of infinite compounding debt.
Because infinite debt would ruin them. Without that 300% cap, the compounding pressure would eventually break the arbitrage models. The vending machine analogy is spot on. You can always top up your account to open a new contract and raise your target, but there's always a hard ceiling on what the platform legally owes you at any given moment.
Okay, I see how the math works in a vacuum.
Uh-huh.
But we're talking about capital being actively traded across incredibly volatile crypto markets at lightning speed.
Very true.
So the natural next question for you as a listener has to be, what happens when the vacuum breaks? Like, what happens if the market crashes violently, or an exchange freezes up, or one of those high-frequency bots hits a catastrophic glitch?
That is where the third entity in their Komoro structure comes into play. ARB Insurance Fund, Ltd.
The safety net.
Exactly. They manage a pool of capital that NeoBank simply calls the return fund, and it acts as the ecosystem's overarching safety net.
According to the briefing document, this safety net operates on two main principles. The first one makes total sense based on what we've discussed, product insolvency protection.
Right, because of the split.
Yeah, because your initial deposit is automatically fractured into 3 equal pieces. If one of those 3 products takes a massive loss or fails entirely, the other 2 just continue trading normally.
The isolated bulkheads on the submarine are doing their job.
Exactly. But the second principle, how the return fund actually pays you back, really made me pause. It operates on a 90-day payout schedule.
Yes, the timeline is very strictly defined.
The sources state that the fund covers up to 33% of the affected capital per 90-day settlement period. Let's zero in on that math for a second.
Okay.
If they are only covering 33% every 3 months, that means if a product completely collapses, it would take a user nearly a full calendar year to recover their lost funds from that specific segment. I have to push back here.
Go for it.
Is this a true insurance policy? Or is this just a strategically designed slow drip feed to prevent a panic-induced bank run? Because look, if my local traditional bank fails, the government insurance steps in and makes me whole relatively quickly.
Right.
Here, I'm put on a year-long payment plan.
This raises an important question about the fundamental difference between traditional government-backed banking insurance and decentralized risk management.
Right.
You are absolutely right to call it a drip feed, but from an architectural standpoint, that's a feature, not a mug.
How so?
Think about what we call a liquidity drain. If a major crypto crash happens and a product fails, allowing every single affected user to withdraw their entire insured amount on the same day would instantly bankrupt the return fund.
Oh, I see.
Yeah, the platform would have to sell off assets at a massive loss just to find the cash.
So by forcing people to wait 90 days between payouts, they stop the bleeding.
Exactly. They mathematically stabilize the platform. By throttling the insurance payouts, ARB Insurance Fund Ltd. prevents sudden catastrophic liquidity drains.
It slows everything down.
Right. Furthermore, it completely avoids the unrealistic, often fraudulent promise of risk-free high returns that you see elsewhere in the crypto space.
Yeah, the too good to be true stuff.
Right. They're essentially telling the user, look, we have a mechanism to protect your capital, but you have to share in the temporal risk. You will get your money back, but on our timeline to ensure the entire ecosystem survives.
Which makes sense.
It is a highly pragmatic approach to risk in a sector known for, well, blowing up overnight.
Pragmatic for the company, sure, but definitely a massive test of patience for anyone caught in that 90-day waiting cycle.
Oh, absolutely.
But this brings up a logistical issue. If the safety net is slowly bleeding out money to cover a loss, a platform like this desperately needs constant liquidity. It needs fresh capital coming in the front door to keep the arbitrage bots fed and the insurance fund topped up. How does NeoBank guarantee a constant influx of new cash?
Well, they rely heavily on the fourth entity in their setup, MLM Matrix Ltd.
Marketing guys.
Yeah, this is their highly structured in-house marketing arm. Network marketing in the crypto space is always, a complex subject.
Definitely.
But NeoBank has formalized it into a multi-grade binary compensation structure.
I was looking at the marketing structure and the sources, and they use this term binary compensation. To me, that sounds incredibly complex and a bit daunting. How does simply bringing a friend onto the platform actually translate into a payout for a user?
It's built on two distinct tiers. If you decide to actively build a network, you first get a 5% direct reward, which they call the personal partner reward.
Okay, so 5% of what they put in.
Right. That's simply 5% of the qualifying investment volume from anyone you personally, directly bring onto the platform. That part is straightforward.
Got it.
But the deeper money is in the 5% binary reward, or network income. This pays out based on the total volume of your entire network structure up to 7 grades deep. People inviting people who invite people.
But the briefing doc makes it clear you can't just invite one massive investor, sit back, and ride their coattails to collect that deep network income.
No, you can't.
They have a very specific qualification rule called the invite to, teach to model.
Yes, the binary structure absolutely requires balance to function mathematically.
Right, because to unlock those deeper binary rewards, you have to maintain at least 2 active personal partners. But you have to place one in your left branch and one in your right branch.
You're building a tree.
Yeah, you literally have to balance the weight of your network tree. And they seem fiercely protective of this specific structure. The anti-fraud rules are intense.
Oh, very strict.
You're banned from multi-accounting. You can't just create fake profiles for your relatives to pad your left branch, and you can't refer yourself from a different IP address to game the system.
The integrity of that binary tree is essential. If users are allowed to create phantom accounts, the multi-level payout math collapses under its own weight.
Paying out money for nothing.
Exactly. Paying out bonuses for capital that doesn't actually exist.
So what does this all mean for the user? I look at this MLM matrix and it reminds me of an exclusive nightclub where you only get access to the VIP lounge if you act as a promoter.
That's a good way to put it.
But you don't just hand out flyers on the street. You have to physically bring in 2 more people, make sure they actually buy a drink, and you have to seat one on the left side of the room and one on the right side of the room.
It's a lot of active management.
It is incredibly orchestrated. But there's a detail hidden in these rules that really surprised me. It's a clause called investment independence.
This is a crucial distinction that separates them from a lot of fly-by-night operations.
The rule states that if you break the rules of the matrix, say you get caught making fake accounts to game the binary tree, they kick you out of the marketing program.
You're done as a partner.
You lose your entire network, and you lose all your pending bonuses. But getting kicked out of the matrix does not forfeit your direct investment contracts with NeoBank.
That's the key.
Your initial deposits, your 300% vending machine contracts, they just keep running normally. Usually, if you get caught cheating and get banned from an exclusive club, the bouncer throws you out into the alley and they keep your coat. Here, they kick you out of the VIP section, but they let you keep your investments.
And this firewall is vital for the platform's survival and its credibility with larger investors. By keeping the network marketing entity legally and functionally separate from the banking entity, they protect their core financial operations from the chaos and volatility of their marketing arm.
It insulates the bank.
Exactly. If someone commits fraud on the MLM side, punishing their actual banking deposit would completely undermine the trust in that international banking license they hold.
It would look like a rug pull. I mean, if they can just seize your principal investment because of a marketing dispute, no one would trust the vault.
Exactly. Investors need absolute certainty that their principal capital is subject only to market forces and the stated terms of the investment contract.
Not the marketing terms.
Right. By strictly enforcing investment independence, NeoBank is signaling to institutional or high net worth players that the banking side is a serious, legally protected vehicle, even if the marketing side operates with the aggressive mechanics of a multi-level network.
They firewall the banking from the marketing. And it all comes right back to those 5 separate companies in the Comoros.
The segmented submarine.
It really is a brilliantly designed machine, whether you agree with the methods or not. So why should you, listening to this right now, care about NeoBank's intricate 5-headed web?
Good question.
Because whether you ever deposit a single USDT into their system or not,
Mhm.
NeoBank represents the extreme frontier of modern digital finance.
It really does.
It's a place where traditional corporate legal strategy, high-speed automated crypto arbitrage,
Right.
algorithmic insurance throttling, and binary multi-level marketing all blur into a single relentless machine. It forces us to completely rethink what the word bank even means today.
It challenges the very definition. It shifts banking from being a passive place that simply holds your money to a decentralized software suite that actively weaponizes your capital across global markets 24 hours a day, 7 days a week.
Weaponizes your capital.
Yeah.
Really like that framing. But before we wrap up, there is one final intriguing detail buried in the source material that we haven't discussed yet, and I want to leave you, the listener, with it. It's a small clause called the mandatory reinvestment rule.
Oh, this one is fascinating.
The rule states that if NeoBank introduces a brand new banking product into their ecosystem, that product will have a minimum participation amount. If you do not currently have a sufficient active balance to meet that new threshold, the system will automatically reserve and reinvest your daily earnings into that new product until you meet the criteria.
Just does it on its own.
Exactly. You don't get an email asking if you want to opt in. You don't click a buy button. The system just autonomously funnels your yields into the new venture to meet a corporate quota.
It's a bold move.
It really is. So I leave you with this to mull over.
Yeah.
If a digital ecosystem is so advanced that it can automatically route your own earnings into a new product without your permission, where exactly is the line between utilizing an automated wealth generation tool and slowly losing total control of your own digital wallet?
A very fine line.
Something to think about. Thank you so much for joining us on this deep dive.
It was a pleasure to unpack this with you. Thanks for diving deep.